And Nike is in the news today because it beat on earnings, but the forward guidance was a little dismal. However, it did increase its sales to China by double digits, so that's good. But remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. So let's go back to these numbers. Now, the blue numbers or the blue lines represent the average stock in our 1,800 stock database, and so that we could see Nike, which are the green numbers, have a better clean surplus return on equity. What's the return on equity mean? Just think about the return on the equity in your bank account. We call it an interest rate, but really it's a return on equity. So we compare bank account average stock of 13.5% with Nike returning 15.7%. So Nike is better in that respect. About net income, how much money is it actually bringing to the bottom line relative to the average stock? Nike is better than the average stock, bringing more to the bottom line. And when it comes to revenue, the gross amount of money coming in, it's beating the average stock by a little bit. However, when we look at the pre-opening today, as I'm recording this on Friday, as today it's down about 3 points. So these are candlesticks, by the way. This red line here is the 200-day moving average, and it's a very, very important line. And we can see Nike has been playing around this line for about 2 weeks in here after being under it for quite a while. Look at this big drop in here. So when we're looking at the 200-day moving average, we know that it's down in the pre-market by a couple of points, and it will be testing this red line once again. However, down here we have an intermediate term indicator which is pointing up, which is good. So we have Nike giving us agita again, and we don't know if it's going to hold at that 200-day moving average. But again, the sales to China were about 13% higher than last year, and that's a very, very good sign. So when we look at the price year to date, black line is the S&P 500. Now remember, everybody's trying to beat the S&P 500. And a Morningstar report came out and said that over any 10-year period, 96% of professional money managers who manage the publicly traded mutual funds cannot outperform this black line over any 10-year rolling period. So it's our job to outperform that black line. And guess what? Nike, this yellow line, is just not doing it year to date. So it's been having trouble in here because of that big drop. Let's go to the past 5 years. Black line again, S&P 500, and we can see Nike outperformed for a while when the market was going good. Then when the market didn't do so good, Nike fell further than the market fell, and right now it's below the market by almost 20%. So over 5 years, the market has not liked this. Now, even though the numbers are better in Nike, as we showed you right here, these numbers are better. How come the market doesn't like Nike anymore? And here's the reason. We are looking, first of all, we're looking at net income, which are the earnings, clean surplus earnings, and we can see they're going up nicely. Clean surplus return on equity is below 20%, so it doesn't fit our model portfolio. We want clean surplus return on equity of 20% or better, because what's the average stock have? Right, 13%. So clean surplus on Nike is showing us it's an above average stock here. However, retention rate. What's retention rate? Retention rate is how much of the money the company is making that it puts back into itself in order to grow. And we like stocks like Amazon. We like stocks like Nvidia. We like stocks like Apple. We like stocks like Netflix that are taking 100% of what they're making, putting it back into the company in order to grow, and they are growing. So Nike is not putting 100% back in. It's putting about 62% back into itself in order to grow, which means to us and the market that Nike is past its high growth stage. This is why the market is starting to shy away from Nike. It's outperforming the market averages in the numbers by a little bit, but the market looks at it and says, I would rather be in other growth stocks than Nike. So folks, Nike is not in our growth portfolio because it doesn't have a high enough return on equity. In other words, it's not being as efficient. It has competition out there, and the retention rate is not near 100%. Now, look at the compounded rates. We're looking at 21 years of returns. Our portfolio, which we change once a year, we're pretty much buy and hold. We'll buy a stock and keep a good stock and keep that good stock until it's not good anymore, and then we'll replace it. So since 2002, that's 21 years ago, we are looking at our portfolio compounded return. This is pretty much a buy and hold portfolio, up over 1,000% with the market up, and this is the S&P, up 377%. Again, note down here, our growth model portfolio is buy and hold with changes, if any, taking place on the last trading day of the year, and most stocks are in the S&P 500 index, and we'll keep a stock in there as long as it remains a good stock, like Apple has been in our portfolio for a very long time. Amazon has been in our portfolio for a very long time, and when you keep good stocks in a portfolio, or if they're not good stocks anymore, and you replace them with another good stock, these are the kind of returns we're beating, outperforming the S&P 500 almost 3-to-1 over 21 years. And folks, remember, Morningstar says the average portfolio manager, or 96% of portfolio managers, cannot outperform this S&P 500 index. So, folks, just go to our website, buffettandbeyond.com, and sign up for the free 2-week subscription, and you'll see an archive of stocks that we have in our portfolio. So do it, folks. And remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. All right, folks, you have a good 4th of July weekend. We'll actually have a couple more videos out before tomorrow. We'll see you then. Be safe, folks. We'll see you next time.